our last panel will be on investing in private firms. And as chair of our firm's valuation committee, I oversee the valuation of all of our investments in our portfolio. And one of the few bright spots over the past few years has been our private investments. And these would include ownership stakes in private companies, private real estate transactions, as well as investing private deals in public companies. So I'm excited to hear from the three to my left, who are all experts investing in private companies. And what excites me the most is the diversity. We have a private equity industry veteran. We have an owner and an investor in successful private businesses. And we have a portfolio manager from Fidelity who invests in late-stage venture firms. So I'm going to quickly introduce them. To my farthest left is TJ Maloney, who's the CEO of Lincolnshire Management, which is a private equity firm focused on middle market companies and has over 20 years experience leading the buyouts of private companies. Next to TJ is Peter Saperstone, who's a portfolio manager and runs a business for Fidelity here in Boston that is focused on providing late-stage growth capital for venture firms. And closest to me is John Morrissey, who's Executive Vice President and Director of J.F. Shea Company, one of the largest home builders in the U.S., and he also invests in private businesses. So all approach investing in private companies with very different perspectives. So TJ, let me start with you. With the hedge fund and long-only industries struggling to make money in public markets, the attraction from my perspective seems to be in less efficient markets like private equity. So I'll start with, what are the 3 or 4 key takeaways for our audience of the buyout industry today?
I have no idea.
That's a good start.
Well, first off, so my firm's been around for 31 years. We've got about $1.7 billion under management. We bought 85 companies. Companies we tend to buy are sort of between $20 and $50 million of EBITDA, although sometimes we'll back a startup. Sometimes we'll invest in a loss-making operation with a view that it will turn around. Our market is becoming more and more exact. And it is what it is. Are also the companies we buy have more and more international exposure, whether it's currency or where they get parts or the markets they sell into. The pricing for the last few years has been pretty high, and I think really high when you think we're looking at whatever they're talking about, 1 or 2% growth. And so the fear is that if you buy something at a high multiple and then the multiples change, it's going to be really, really difficult to make money. So if you buy something at 10 times when you really think it's worth 6 times, and go to sell it 3 or 4 years later, and suddenly there's a correction, and all you can get is 6 times, it's going to be hard to make money. I think there's less to buy in the U.S. I mean, as so many things have moved offshore. I mean, we used to buy sort of plain vanilla pump businesses, little manufacturers across the country. There's not many of those left anymore. I think it's the last 5 or 6 years. I've personally been doing this for 24 years. The last 5 years have been tough. I think it's a tough business for any students here. I always meet these people who want interviews. They want to get into quote unquote private equity. You just basically show up on the yellow brick road and the money falls out of the trees and life is great. It's a very, very tough business. It's a hard business. And the people in our office, they work around the clock. They work weekends. There's a lot of stress, sometimes a lot of confrontation. The company misses its numbers. You're not in really friendly conversations with the lenders. So it's not a business for the people that want to have sort of a normal lifestyle. This is a high stress, high confrontation kind of business. And so I don't know. That's
Great. Great. Well,
That's an upper.
being in the hedge fund business, I don't feel so badly. Okay, so I'm going to now actually jump to the other side of the spectrum with John. So John, you run one of the most successful private businesses in a very dynamic and growing industry, home building, and you've invested successfully in other private companies and have a very different time horizon than TJ for holding these investments. So it's something I might refer to as forever capital. So maybe just share with the audience how and why this might be a competitive advantage.
Well, we invest in funds like TJ's. We like those funds. They often do very well. But we think we have a structural advantage because he calls it forever capital. I think I'd prefer to call it patient. We don't have to worry about getting paid a carry. We don't have to worry about raising another fund. We don't have to worry about LPs who have a particular rhythm to the investments that they're making. So we can be a little choosier. We could, I think Warren Buffett talks about waiting for the next pitch. And so we do have that benefit, if you will. And the other thing is, a lot of times you'll see it in some of these funds, you'll have a company that's done really well. I mean, maybe it's the best company in that portfolio. And you'll see them selling it, sometimes to another sponsor. Sometimes they'll take it public, but more often they're selling it to another sponsor. And that you realize that they have to sell it because they got to raise another fund, and they got to feed their kids, and they got to send their kids to colleges like Boston College, and they're not cheap. But they're great. So a lot of times you want to let those things season and let them run, if you will, and compound without paying Uncle Sam his tax. And so if you can allow those things to compound, it's really great. I once asked my father-in-law, who started this thing, why were you so successful? And he said, I lived a long time. and there's a lot to it. I mean, he sort of was able to let his bets run. Home building is a very cyclical business. I'm not sure it's really sensible for us to be private, but it works for us. The better business for us is the multifamily business, where we develop for our own account real estate that throws off cash that we don't have to sell. The problem with home building is it's a very capital-intensive business. So part of our most patient capital, if you will, and our most rewarding and most tax-favored way of trying to generate intergenerational wealth, which is our ultimate goal, is the multifamily real estate, which is the most patient because you can sit there and collect your rent, literally. I heard Larry complaining about rent seeking. I didn't think that was so nice.
Yeah.
But that's basically our approach. And we take a similar approach to investing outside the operating businesses. We try to find companies where we can invest alongside people we trust, hold on to them for a long time, not have to sell them before they're ready to go.
Great. That's a very different perspective than the buyout business or the venture business. So, Peter, your business is very dependent on separating good from the bad. You're out pursuing these unicorns, which I think is a great rarity. And I don't have any idea how you can separate the Ubers and the Snapchats from the rest. So maybe just share with us how the process of sifting through hundreds and hundreds of deals to find the successful one that your team's going to do work on.
We own both, so we've hedged our bets there on those two. But just a little bit of background. So we've been publicly investing in our public funds since 1946, and about 7 or 8 years ago, we started to see a lot of the private companies staying private longer. And so typically, I'd run a small mid-cap fund back in the last decade, and there was plenty of great growth companies in that time frame who were $500 million cap, who would grow to $5 or $10 billion cap. And so we started seeing a lot of companies staying private longer for a bunch of reasons that I could go into. So we were kind of missing that investment part of the cycle. We also, typically at an IPO, we meet the company on a Friday. They ask us if we want to be in the deal on Monday, so our due diligence period is pretty short. The allocations usually aren't great, so that was that was another negative. And then finally, I'd say, if you're doing analysis on public companies, if you exclude the private companies in terms of kind of your competitive set, you're missing a whole group. So we also look at these companies to help the public funds. So that being said, we do the research and the analysis and trying to find these companies is very similar to the public companies. I guess the benefit is that we sign NDAs, so we're brought into the we know more information. The negative is if you invest, you're kind of in forever, whereas our public funds obviously can sell tomorrow. But the thought process was, again, to get in early. We typically have, so to answer your question, we do the exact same analysis. We have a team of, there's 3 or 4 of us on the private team, but we utilize our 100 analysts on the public side. We talk to companies across all the industries, public and private. So we've got a vast resource of knowledge there, and to rely on. I was going to say, just in terms of our goal in buying these companies, to hold them privately, to hold them at the IPO, to buy more at the IPO, and to own more, post being public. And so it's more of a life cycle approach, and the idea is to get in earlier. So I wouldn't say it's that different from what we were doing before, just that the world has changed a little bit in terms of where these companies have been. So they were public, now they're private, so we want to still be there.
What would you say is the average hold period for you once you make an investment?
For the privates? The goal, I would say, so we do late stage, so it's crossover pre-IPO investments. Ideally, that's probably a 2 to 3 year time frame. But unlike some private equity or venture firms where there's a finite time frame on a fund, we have permanent capital. I should clarify that these investments are going in the public funds too. So we don't have separate vehicles for these investments. So there is permanent capital, so we're not forcing them to go public tomorrow if it's not right. And we are also, by the way, we're passive, we're not activists. But typically, we target about a 2 or 3 year time frame.
Well, can I ask a question? When you look at the companies before investment, do you have as much information or more information or less information than you would for a company that's a public filer? And then the same question post-investment.
I'd say more information privately, and then post-investment less.
But privately, you're subject to non-disclosure agreement.
And so our group is separate in terms of the information does not go
to the public.
Into our public side at all. Yeah.
So maybe just for the benefit of the students, just talk about the differentiation, public and private.
In terms of the
deal flow or the evolution of it.
I would say we look at. I was on the public side for 20 years. I've done this for about a year now. On the private side, I've looked at hundreds of deals. I've done 2. Whereas on the public side, the universe is a lot smaller. I ran a consumer fund, a large cap consumer fund for 5 years. I probably couldn't go lower than a $4 or $5 billion cap given the size of the fund. My universe was 100 companies.
Right.
And you knew, Home Depot, you knew these companies. They weren't new to you. These 100 companies are all emerging companies. Whether they're tech software companies, social network companies, a lot of e-commerce, media. So the knowledge, the ramp is steeper. But again, we're doing the same type of analysis.
Got it. Great. So, TJ, maybe if you could talk a little bit about the deal sourcing, the environment today. It's super competitive with the mega buyouts of KKR and Apollo, Blackstone. So how do you go about differentiating that sourcing for private company investment?
Well, historically, we would get deals through finders and brokers, and we thought that was a better way to get deals because one is you'd get better opportunity than through investment bankers, and Two is if there was a finder or broker involved, usually you had a real seller. If you call directly on companies, one of the problems you run into is somebody wants a free appraisal, or he wants you to come out to his country club and show everybody he's got some guy in from New York. So that doesn't work so well. The finder broker network we build up is a little less than 8,000. It changes all the time. Some of the groups are very professional, and some of the people you have to make sure you call before lunch. That's changing. When we first got into this market, there were only 3 or 4 investment banks that covered our space. Today, I'd say there's 350 investment banking firms that now cover our space. So now the deals we look at are more auctions than marrying opportunity and capital, which usually gave you a price opportunity. It sort of is what it is. I mean, with the internet, I get, car washes in Calgary, Alberta are for sale for $350,000. I'm like, so it's a changed world. So making money on the buy side is more difficult. So you have to do something else.
Follow-ons still inactive?
That's the soup du jour. Is a lot of people are buying a company with a view that they can quickly add on some other businesses, cut expenses, consolidate facilities, and that type of thing. And we've had some good luck with that recently. I think we haven't yet sold it, but we're close to.
And then just in terms of dollars, maybe just describe what the original investment is, and then the follow-on.
Okay. So I have to remember what we bought this thing for. So we bought a business, I want to say roughly for about $120 million. We put up about $60 million equity, so 40-50%. We then did some add-on acquisitions off the balance sheet because the company was performing well, so we didn't need to either put in more equity or borrow more money. And then we did another acquisition that was about another $60 million of equity, and increased the debt to about $220 million. It was a little bit pricier, I think. But we identified $28 million of synergies.
Great.
We've been able to execute on most of those.
Great. So John, I'd love to hear a story about some of the successful investments you've made away from the home building business, and then maybe start with just talking about how you sourced it.
Well, it's interesting. When I first got into this, I had a database of deals that had been done before me, and then actually I waited a year or two and looked at deals I'd actually done. And we categorized them by source. And so people would, come to us and say, you ought to buy this company or a piece of this company or come alongside us and do this. And we don't have the resources that a firm like TJ's has or Fidelity has to really look under the hood or do an industry-wide due diligence, and we don't really have industry expertise. So it's really important to us to know that somebody who's investing alongside us has skin in the game. And sure enough, when I went back and looked at this data set, the deals that were shopped to us had a much poorer track record. Of course.
Right.
Where people had skin in the game, we did a lot better.
Right.
So that's rule number one. Does somebody have skin in the game? Number two, does somebody that we're investing with, ideally we've done something with them before, we have some basis for trust with that person. Sometimes it's nice if it relates to our industry, something that we can do to help accelerate that business. If they're selling to homeowner associations, for example, or to heavy construction companies, things like that, we can do things to help them and get a reward, if you will, for seeing that company do well. So that's a sort of a checklist of things that we need to have. We have to be able to afford it. We have to think it makes sense in terms of price and the rest. All the things that TJ talks about too. In terms of examples, this will give you some sense of how Catholic our tastes are, small c. one of the best we ever, I mean, the single best, I think, is the multifamily, but you asked for stuff outside. We invested in a general partnership for an alternative investment manager. We knew the people, they were coming out of an investment bank, trusted them, they wanted to start this business, they needed capital to do it. We provided the capital, and over a 20-year period, it was a 20% IRR. That's where I first realized the benefit of not having to take your money out. I mean, to be able to compound at that rate for that period of time, you can do the math and figure out the multiple. It was very attractive. Unfortunately, that partnership was a 20-year partnership, and the people who were operating the businesses actually realized that this was such a good thing, they didn't really need us anymore, and so they excused us from the partnership. So, note to self, make sure the partnership's longer. Or you used to have the option to stay in if you want. Another example, a fellow was taking over some Seagate disk drive manufacturing business in Thailand. And Seagate no longer wanted to do this themselves. They wanted to essentially outsource it. It was very early days of the outsourcing or offshoring movement, if you will, globalization, run amok. It was about 1999, 2000. And so he didn't really need money. He wanted to borrow money because these things were going to throw off cash. But in order to borrow the money, he needed to have money, which is, that's the way bankers are. So we provided the equity capital, which he never drew, never used, because he used the loans exclusively, the working capital. And that company, we put in $1 a share. It's now $33 a share. It now trades publicly. But the lesson of that is, it went through some pretty tough times.
Right.
I mean, we shifted from disk drives to optical to lasers and all those things. And if we were public, while we were trying to do all those, migrations, it would have been hideous. We would have wondering what we were doing. Every day we would have looked at our share price. But instead, we were able to have the thing compound. Now, we have had problems since it went public. There were some floods, put us out of business for a while. And that wasn't much fun. But when you know the business this long and you own as much of it as we do, you think of it as a long-term hold, and so you hang in there with management as long as you trust.
Well, I think the point that you made really illustrates the advantage of owning it with equity capital where you don't have a time limit on it, compounding at 20% per annum pre-tax, right? So your money is doubling every 3.5 years, approximately.
I would say two things, though. One, these things don't grow on trees, unfortunately. Number two, it doesn't always go up and to the right, and they don't always go forever. That's why I wouldn't say forever capital. J.P. Morgan did an analysis a couple years ago about concentrated stock positions. And one of the points they made was that since 1980, 320 companies have exited the S&P 500. Now, some of that's acquisitions and mergers and consolidation, but a lot of it's just they couldn't keep up. Yeah. And so you have to know, it's not forever capital. It's got to be patient capital. You got to know when to hold them and fold them.
Versus my business, I'm going to keep calling it forever capital.
Well, for him, forever was 2 to 3 years.
Yeah. So, Peter, John just made the point about the importance of skin in the game, which I believe, is a critical component in looking at an investment. So, how difficult is it in your business where you're looking at companies, short period of time, it may not have any positive cash flow because of the growth trajectory and the investment, the CapEx is so great. So how do you equate that skin in the game for the owners?
Yeah, I think there are a few but things you look at in a transaction. Obviously, if there's ideally, they're not selling stock, so it's not a secondary. It's a primary raise. Ideally, the VCs who might have done the A or B or C round are putting a little more capital in, and they're not selling either. We like to also invest with some of the more knowledgeable partners in the industry too. So we're not doing it solo, or we know the players from prior deals. And then management, we love for them to have a big stake. The issue with a lot of these startups is as you pointed out, a lot of them have burned a lot of cash over the years, and they have to raise capital, and by the time they get to kind of a Series D or E round, they're down to 10% of the company. And it's like, well, so that tells us, that the business is kind of a capital or a cash flow hog, and B, there's less skin in the game. So ideally, these are companies which are better models. They have the founders have higher equity in the business. They're not sellers. So those are some of the criteria.
Great.
Outside of fundamentals.
So let me switch and talk about now some of the risks and some of the lessons learned from investing in private equity and private companies. So Peter, what would be some of the key lessons learned from investing in a failed business? We've all had failed investments. The track record isn't perfect.
Yeah, it's interesting. When we look back at our investments, we've done, I think today we own 70 companies. Probably, we've exited probably this, a similar amount. So and this is over a 7-year period, or maybe exited half of that. So, but of the ones we've, as we go back in time and look at what's happened, typically a private company when they come to you, unlike a public company, will give you optimistic forecasts. Because they're doing a deal, right? And public companies typically they'll go on the analyst call, the analyst day, and they'll be, they'll kind of set the bar lower basically. So that's one transition that I think I had to make, and the public investors have to make to understand the numbers are probably optimistic. So you kind of shave that first off.
So the point you're making is public company CFO treasurer is going to give you normal, realistic expectations because they have legal risk. If they don't, and on the private side, they're going to show you projections that are going to look like a hockey stick.
Right. So first of all, it's a hockey stick, but it's also probably too high of a hockey stick. They're all hockey sticks. And so I would say that I think we have to be careful, or want to be careful about the projections. And the majority of what of our bad investments haven't been valuation, it's been fundamentals. A lot of the ones, Uber looked very expensive in our first investment at I think it was at 17 billion, and it's the last public round, the last private round was higher than that, multiple of it. So and so in that case, I just go back to the fact that the fundamentals kind of trump valuation some of these more, these smaller companies. So again, I go back to just making sure we have the numbers right, they make sense, and I think that's kind of the key versus other factors.
Great, thank you. TJ, how about you and some of the lessons learned from a 20-plus career in buyouts?
Well, I guess you're always going to have failed investments. I think a couple of things. One is one of the important ingredients, I think, for being a successful investor is humility. And when you see people that are in love with themselves in the investment community, it's usually a good time to walk away from them. So I think that's important because you're only just one deal away from, blowing your money. I think it's important to recognize when you've made a bad investment and not keep feeding it. Mm-hmm. I've had friends that have run firms that are no longer in business because they just had too much of their capital allocated to one investment. A lot of times people think that you invest in something that doesn't work out because you didn't see something. It's rarely the case. Usually you see it. You see it's a risk. Most of these investments, I like to compare to the scales of justice. You got 150 grains of whatever it is, salt or sand on one, and you got 149 on the other, and it's just that one little grain that causes you to go left. It's, to us, what happens is when we look back on things that have not worked out, is we bought the mitigants. Someone always has a mitigant to the risk, and you buy into it, and usually, that's what happens. What has been for us is we buy undermanaged situations. I have 6 CEOs that work for me, so we're generally prepared to go in and run the business ourselves. And so we've taken some situations that have gotten off track and been able to turn them around. When it's a management issue, sometimes it's a market issue, and then you have to really make a different decision when it's a market issue.
Got it.
I'd just add two things. And I would underscore one point and make it a different one. The point I'd underscore is compounding a mistake you made. And for those of you who've read Danny Kahneman's book, this will be old news to you, but it was new news to me when I read it, which is that when you get into a loss position, you go from being naturally risk averse to being essentially risk perverse. You think you can hit a home run, you think you can throw the Hail Mary pass and connect. And I think our biggest mistakes, most expensive ones certainly, have been where we forgot that lesson. And we sort of doubled down on something. The second mistake, which I would add to this, is sometimes you invest, when you're investing in a private company, a lot of times you're not just investing in fundamentals or an idea or whatever. You're investing in a team, and often a person has brought you into it that you had enormous trust with. And that person was the right person at that time for that business. And the problem that you confront a lot of times is it's really hard to make a change when you know intellectually you need to, and emotionally you can't. And you get into trouble sometimes for not making the change you need to make in the management team soon enough.
And you're speaking specifically on management.
Yes. Yeah, exactly.
Got it. So Peter, because your business, you're looking at the next revolutionary idea. A lot of it's related to tech. What do you see, and I'm not asking for names, but what do you see as the themes in the types of businesses right now that are going to revolutionize how we live, how we work, and could you just spend a few minutes on that topic?
Oh boy, I'll try. I'll just clarify. We have investments. We actually are growing EBITDA 15%. They have EBITDA. So there is a piece of it. It's probably not the majority, but there is a piece of it which are good old private equity stories. Kind of later stage, which might go. They need that last round of capital for acquisitions, and the visibility 2 years out is not. It's not changing the world. So that definitely is a piece of what we do, and there are fund managers at Fidelity who like that flavor. Whereas there is probably a little larger group which tries to find that next Google or Facebook. And so I'd say the biggest trend I've seen in consumer and media and some of the tech and some of the non-hardware tech and software tech is just what's happening with kind of the millennials. It's an overused word, but just the mobile aspect of it, the millennials, has created just a different type of consumption environment out there, whether it's this Ubering or Airbnb or wherever else. And so but ironically, it's probably had more of a disruption on the legacy companies than a benefit on the new companies. So it's tougher. It's challenging to find.
Interesting.
There's a handful that have arisen from this, but it's really been more of a kind of a negative for any legacy, taxi cabs, hotels, just media companies, networks, and so that's been almost as helpful for our public funds. The fact that we've seen these, a lot of new companies who are disrupting, traditional industries and avoiding those companies publicly. It's a challenge to find, again, a lot of these companies like Snapchat or Uber because there aren't a lot, and it seems like it's winner take all in each of those segments. So we're trying to find them. That's why I think you have to be a little bit. You have to have a very low batting average in terms of what how many we invest in terms of how many we've seen.
Got it. So you're using your pipeline basically to look at secular changes in companies that you own in the portfolio, or how it might affect their business.
Well, I mean, our goal on the private side is to find the next, the next big companies. But I'm saying, it's almost more challenging to find that than, it's easier to realize who's going to be impacted versus who the winners will be.
Great.
But we have a whole list of ideas there still.
So just maybe one final question, John, and then we'll open it up to questions to the audience. Is given all that we've heard today from Larry, from Richard, and and Kaplan, is your business now, are you playing offense or defense with that long-term capital?
Well, it depends on where you're talking. If you're talking about in our real estate businesses, it's kind of depends on the asset class and location. So we definitely think we're in the ninth inning in multifamily in terms of the ability to buy land affordable, develop it, and the like, and to be able to do that in a sensible way.
Mhm.
So we're probably on defense there. Home building, again, it kind of depends on where you are geographically. It's very strong in California, parts of Denver. I was surprised by President Kaplan's comments about how consistent the growth is, because that's not our experience.
Right.
It seems very different, country by country. And we've let a few pitches go by, I would say. Certainly in the later stage venture space, we haven't done a late stage venture deal in 2 years.
Now is that valuation?
It was valuation.
Yeah, okay.
It's valuation. And we can't compete. I mean, in the Valley you hear, and I don't mean to knock you for this because you may be more committed to the space than others. There's a sense that some of these hedge funds or larger mutual funds have kind of waded into the space to try to get a little zip into their portfolios, and that they may not be there next year or the year after. And so there's a concern that they may be tourists in that space. And that's one of our concerns, and so it's made us hesitant to buy at those valuations.
Sure, there's no question. I mean,
But if I could have bought Uber at $17 billion, I would have too.
Yeah. I think we all would have. Okay, so why don't we open it up to questions from the audience? Sure.
Question for TJ. When you buy a controlling interest in a private company, what are the typical levers that you pull to try and create and enhance the value?
Well, I mean, I guess that usually there's one is you hope you buy the thing right in terms of pricing. That's defensive as well as offensive. Secondly is you're using leverage, so that helps drive your returns. Then you're evaluating the business model and the projections. Many times when we buy a company, it takes on average between 3 and 6 months to buy it. Sometimes I have my own people at the company for 3 to 6 months putting together the data which they may not keep. So then you get to understand the business and you can see what you can do with it. Sometimes it's acquisitions, sometimes it's new product introduction, sometimes it's new markets. I'd say 60% of the companies we buy were clearly right away beefing up the staff on the financial side of it, sort of just to batten down the hatches. And 50% of them were adding marketing people or sales people along those lines. So I don't know if that answers your question.
Great. John?
Peter, with the last downturn in the first quarter, there was a lot of media coverage of Fidelity marking down valuation on some of the investments that maybe we didn't see prior to this more recent phenomenon. How has that played a role? How is that good for things? Can you just describe sort of what the impact is as you as an investor? And whereas we might not have seen that clearly in the public forum before, now we're seeing markdowns for the first time more clearly. Can you describe that a little bit?
Who it's good for, bad for? I'm not clear on.
I guess the question is, what were some of the markdowns that happened in the first quarter due to revaluations, and now you're bringing down a private
Right.
valuation you guys didn't have?
Yeah, we have an independent committee who does that, and we've been doing that since we've been investing in private. So it probably became more public. I think the Journal or a few of the publications started tracking it monthly. So I think that's what the public saw but it was always happening, and maybe and they they don't report on the markups, by the way. It's just the markdown. So a lot of those were markdowns from markups. So I think it's just more just that I think the Journal or Forbes has a dedicated person doing that for whatever reason.
So your point is it's paper gains, paper losses. Net,
Yeah.
it's still paper gains.
Yeah, I mean we stole The ones which are marked, we're loaning these companies, and so it's I'm sure you understand the fair value process, but it's a function of that.
Does it make your capital less attractive?
It depends. I mean, we've heard back from VCs and some companies who don't understand it, who think it means their company's worth less. The employees, it's bad for the employees. So we get that, but I think that we try to be clear to them when we go into our first meeting, if we're an investor, that because these are held in public funds, that's what we do. And I think they understand it. And the more educated ones, I'm not saying that they're all educated, but the ones which understand that, realize it's because of where we hold these and why that process is done. And over the long term, I think the fundamentals will kind of just drive it. But it's part of the process given the entity that invests in these companies.
And I can add that it doesn't matter public fund or holding it in a private entity, and we're subject to the same fair value principles on valuation. We won't get a clean opinion from our auditors if we don't value anything, even privates, illiquids, at fair market value. And the auditors have become much more detailed in their analysis and looking at comps and having us go to third parties, which I think is just a result of the making sure their liability is as small as possible.
The difference is what you do doesn't get picked up in the journal, and the journal reports that you guys just mark down, company. Now everyone goes, oh, what's wrong with that company, right?
Right.
And what TJ does, John does, what you do, doesn't get covered. You guys get covered.
Right.
Thank God.
Great.
We didn't invent it. It's been happening well before we started doing this.
Well, thanks, Peter. That was great. Yes.
Just a question to the panel. Heard that access to capital to fund private firms has gotten much more difficult to get over the last 12 months or so, with no brightening in the future. Can you comment on that?
Well, I can give you a couple of anecdotes. We had a company that was growing. It's terrific, startup company. It's going 25% a year, 30% a year. We had a term sheet in November, December timeframe, which was 50% up from the last round. Come the turn of the year, we had to basically do an inside round at the last valuation. And that's a fairly typical story over the last 9 to 10 months, I would say, 12 months even, at least in that area. I can't speak to.
I would just say I think valuations have come down. I think there was, to your point, there was a lot of crossover money, including ourselves, who got bigger, later. But we've been there for, we don't plan on leaving. But so I think I think in the deals that we saw, they probably peaked in mid 2015. They've definitely come off. I think companies have been a little more realistic on what the company's worth maybe today versus then. And we'll see how 2016 transpires, because some will need to raise capital because cash flow. There's a cash burn issue. So it's probably, I would say, just in general, it's probably better for the buyer than the seller today versus a year ago, and probably gets a little better.
Going way back.
Yes, I have a question about capital gains treatment. Since leading candidates in both presidential parties are talking about changing that and exposing more to regular income, can you speculate on what increase or what change would begin? How big a change would affect the industry? How quickly?
Are you talking about getting rid of capital gains, or changing the rate, or specifically the carried interest treatment?
Carried interest treatment specifically, and at least a change in the rate, if notwithstanding a complete abandonment.
I'll start.
TJ's the most affected by
TJ
this.
probably knows the
So,
most.
if you listen to Donald Trump, he's going to tax the carry or the profits we make as ordinary income, but he's also proposed his ordinary income rate would be lower than the existing capital gains rate. So, I don't really get that. I think it's a political issue. I think it's a populist issue. Our country has changed, and I don't think for the good. I mean, taxation here wasn't meant to be, income equalization. It was meant to pay for services, and it's evolved a long way away from that. And there's a lot of envy in Congress. I think they see people have made a lot of money and they don't like it, so they're going to find a way to get it, I guess. What the rates will be, who knows?
Great. Sure.
TJ, do you see, just in your portfolio, do you have to hold the companies longer before disposition or whatnot? And then also, that would affect the returns to your investors?
Yes. So, we've had 5 different cycles of investing, and there was a period of time where one of our cycles we were turning on average every 24 months overall. This most recent group is probably getting out closer to 40. I've seen every fund, it sort of gets pushed out a little bit. It may or may not impact returns simply because it's all timing of when you sell things. So, our prior fund, we sold 2 companies within 13 months of buying them, and each of them were 6 times invested capital. Then we have a bunch of companies that we haven't sold, 5 or 6 years later, but everyone's already gotten back a multiple of their money, so these things we're really just holding on for multiple of capital as opposed to being IRR driven.
There's an odd tension between the investors and the GPs of those funds. And it's odd to me that many of these investors, in part because most of them don't pay taxes, are very focused, almost fixated on return. As a private investor who pays taxes, I'm much more interested in multiple, which is exactly what TJ's more interested in, because that's how he's going to eat. And so it creates a very odd dynamic between the GPs and the LPs, I think, in terms of how they manage the funds and how they get evaluated.
Especially when you add hurdle rates, which are now coming more and more in vogue.
I can just comment on one thing, and I have a lot of respect for the things that John says here, but we're not always driven by what's best for the GP. I think there's a big presumption that, there's a herd of greedy people out there. So I commute into New York City. I walk through what used to be called the Pan Am building. Now it's MetLife. I work in a building that used to be called the Wang building. It no longer has a name. None of those companies exist anymore. Today, if you look back and you think at the time that Pan Am would no longer exist, it's mind-boggling. They dominated international flying. So in our view, nothing's forever. And so as soon as I can see myself getting to a profit, it's got to be incredibly compelling that next month, next quarter, next year is going to be more profitable, because the future's unknown, and where you are today, you've got a much better insight than you do 3 weeks from now.
I wasn't implying that it's interest.
No, I wasn't suggesting you were, just the rest of the audience. No.
Sure.
TJ, when I took Pan Am a lot, my bag never made it with me when I got back. That's probably the reason that they never made it. Really more for
You don't look old enough, so.
I did take it. I lost my bag a lot. TJ and John, maybe comment on the lack of liquidity for the private companies. There's no IPO market now. What's that doing, from the standpoint of, the companies, fundraising for venture firms, in general? Where do you see it going? Is that going to come to an end soon, or what's your opinion on how it's trading?
Is that for?
I mean,
Yeah, I think the lack of an IPO market the last 6 to 9 months has hurt, obviously, exits, so it's hurt the amount of capital. There's only so much capital you can put in, so you need exit strategies to put more money in. So I think that's been the biggest impact. In fact, I was looking at a chart earlier. I think Silicon Valley Bank had, it showed the amount of the private IPOs versus public IPOs, anything above $100 million, it was like 4x private versus public. And so at some point, there becomes a kind of a log jam, right? You have to get it out the other end. And so I think that is having an impact a little bit on valuations, on the ability or the incentive to put more money in privates.
I will say this, that notwithstanding my comments about patient capital or forever capital in certain businesses, if you're in the venture business, your goal is a liquidity event, either to be public so you have shares for your employees, or so the venture funds can declare victory or the management can. As a result, the private market ends up being correlated to the public market. So you're not really escaping the public markets by investing in that part of the private market. And so yes, I agree with Peter's comments that it's gotten tougher, because as the public valuations come down, as the IPO market or window closes for a period of time, it just trickles all the way down and affects really through all stages, unless the early stage, but eventually it gets there too.
Yeah, and I just add to it, and this gets to some of John's comments earlier, is first off, I don't like taking companies public. I really dislike it for a bunch of reasons. Number one is it's not a liquidity event. It's not a realization for my investors. I'm just swapping one currency for another, my valuations for what the public says. So you didn't really get your money back. So it's a bragging rights, I guess, but I'm not a fan of it. That's number one. Number two is most of the companies we buy are not successful at managing themselves on a quarterly basis. And the public game is all about beating your estimates by 1 cent every quarter, no matter what. And so our companies that were too small for them generally, and the ones that are big enough, I'm not so sure I like the expense or the distraction of management. Running around, giving road shows, and getting on stage.
Yeah. Okay, we have time for one more question.
6 months ago, Elizabeth Holmes was worth $4.5 billion, and 2 days ago, Forbes updated that value to $0. So what went wrong there? Is it the VC ecosystem? Who's doing wrong? Who's doing what wrong? Is it due diligence? Are we in a bubble? What's going on?
Who wants to
The
take?
short answer is I don't know. But from what I've read, they asked about big mistakes. I think sometimes people make mistakes. I make mistakes sometimes. Investing in a deal because somebody else is in the deal. And I think Theranos is an example of that. I mean, I was at Walgreens or somebody did almost no due diligence on the product. It just needed, partly for strategic reasons, partly because of who was already invested. They just sort of accepted at face value what the claims were. And there's no shortage for doing the work, I think.
And there's a lot more, I'd say, I've noticed this, there's a lot, being a private company, even though we might get more information, which is under these agreements, it's not going through they're not filing through the SEC. These are credit investors, so buyer beware more in the private market, right? Whereas that's a lot. I mean, it's happened in the public markets back in with Enron and WorldCom back in the day, but it's a lot more. It's a higher bar, so it's just a more challenging market.
Great. Well, thank you, and please join me in thanking. All right.
All right. Listen, just final remarks, but not really final because we have one other thing we're inviting you to. But I think we'd all agree that everybody here is basically makes their livings based on the ideas and what you know. I don't think anybody here makes their living from heavy lifting. It makes their job life from heavy lifting. Everybody here is knowledge professionals. And I think it's worthwhile to take a day like this and remove ourselves from a day where we're focused on doing tasks, getting things done, and immersing ourselves in a world of ideas. And I think we all agree there were great ideas today, and we all learned something. So hopefully, we felt it was well worth our time to invest in this day. We want to thank you for your time. But then after we get these ideas, it's worth thinking and reflecting about what they mean for us as experts and what they mean for our clients. And so we should do that after today, and we can begin now. We're serving beverages and down the hall in the spirit of BC, some excellent beverages. And stay for a while. Let's network. Let's learn from each other. Let's talk about what we heard today, and keep growing intellectually. So join us for cocktails. Thank you all. Thank you, Dan, Jim, Renee. We made it. Great day. Maria in the back who helped choreograph a great team. I want to thank the team, our team, who put this together. 10 years ago, we could never have pulled this off. This takes a lot of work, a lot of logistics, a lot of skills, and I'm just proud we're ramped up, and we have a great team that can do this now and do it so well. And we have the great support, Dan and Jim and John Reuter, who did a great job. I know he's home helping with his kids right now. So thanks, everybody. Let's have some cocktails, some beverages, and we'll see you next year.